We are live. It is Smarter San Diego. Of course, Mr. Carlsbad, Bryan Devore is here. Welcome back, Mr. Carlsbad.
Thank you very much.
Great to have you here. And Steve Ruderman is here today. Steve, welcome to the show.
Thank you so much.
Now, I had no idea until just a couple seconds ago that you run creditcollectionnews.com.
Correct.
Now, that was a website for my entire radio career that I used for show prep almost every single day. It's an awesome site where you can get information about all this stuff. And specifically, and I talked about it a lot of times on the radio, student loans and what I call the student loan epidemic.
Absolutely.
Because it is something that has infected almost everyone. I mean, there are very few people, unless people just simply do not go to school. If you go to school, you pretty much, most people are stuck with student loans for a very long period of time, and it's causing a lot of problems. So that's what we're going to talk about today. I mean, you probably have more research than I do, but I know we have close to $1 trillion, if not over $1 trillion now.
About 1.4 trillion.
$1.4 trillion in student loan debt.
Trillion. Yeah. It's crazy.
It's just remarkable to me that there's that much out there. In fact, during the the last financial crisis, there was about $1 trillion in bailouts for different various financial institutions and actually stuff that followed directly to the consumer. And my advice to the government was just pay off everyone's student loans. Like that'd be the best thing you could do for the economy.
Yep.
Because the student loans, they siphon money away from stuff that people would be spending on.
Absolutely.
Like buying a house.
Buying a house, cars, clothes. Like, you have to make a set because you have to pay those loans back. So how bad is it, Steve, really?
Well, it's a massive bubble. If you think about $1.4 trillion worth of debt out there, it's an insane amount of money. And that's what's causing tuitions to continually go up. It used to be, in the olden days, you graduate from high school and you go into the workplace. And as we progressed on, you would move on to college. And now everybody needs to go to college to succeed in the workplace. It's very difficult to succeed in the workplace with just a high school degree. So that's what everybody is doing. And the government, in its wise wisdom, decided to make it easier for students to pay for it. So they said everybody should be able to go. So they start offering student loans, guaranteed student loans. And I used to call it in the industry the mirror test. If you can fog the mirror, you're getting a loan. And so more money was flowing in, thus creating an inflationary type of problem in the colleges. So their constantly tuition keeps skyrocketing, and thus you have to get more student loans. And it's just it's a snowball effect. And it just keeps running down the hill. And eventually that snowball is going to get so big, it's going to explode onto something. And right now we're at $1.4 trillion.
Is it not already exploding? I mean, that's the question. So, like, one of the things I do every year is I go and speak to the kids at Claremont High School because of a program there called the Academy of Business Technology, where they're very outside of the box. They bring a lot of outside speakers in to talk to the kids. Mm-hmm. I talk to the freshmen, and then I talk to the seniors. And what happens is the conversations are very different. The seniors, a lot of times, they know where I'm going to school. They might even know what it costs, or they have a couple ideas. They've got it narrowed down. Freshmen have no idea. But my whole point of going there, and the entire presentation, is about looking at your cost of college as an investment. And what are you going to get as a return on that investment? Because I can't tell you how many people over the years, through the radio show, through this show, who've reached out and who say, I have $110,000 in student loan debt, and I have a psychology degree in psychology, and I still can't teach it. I still have to go get that.
Right.
Yep.
Right.
But I'm $110K in, and I'm thinking, how is this possible? How could you possibly have that much? And it's because they're not just giving you student loans for the education. They're giving you student loans for everything, for the entire college experience.
Absolutely.
Your rent, your food. They don't want you to work at all, which sounds great, except you have to pay the bill.
Yeah.
Yeah, it's going to come due, and then you're going to graduate with this massive amount of debt. And suddenly, I mean, think about when, I know when I graduated, and I had taken out a little bit of student loans because I worked and supported myself and tried to take some of the debt away from my mom, who was paying for stuff as well. And when I graduated, that was about $100 a month to pay off the student loan, and that was very doable. But now think about it, you can end up with $100,000, $200,000, $300,000 worth of debt. And with that's a mortgage. And you're graduating from college. You're getting your first real job. Can you afford a mortgage at that point? And the answer is probably not.
A mortgage and a mortgage. I mean, like,
So you're already way behind. And always the joke was, you know, once your kid moves out to go to college, you change the locks on the door. Well, guess who's moving home because they already have a mortgage? They can't afford two, so they're in trouble. And this is what they're running into. Yeah. And this is the epidemic that, just like the housing bubble,
right?
Suddenly you're going to be in trouble.
Yeah.
Whoa, housing bubble. Whoa, oh,
yeah, what was that?
Different conversation.
10 years ago, not now.
You guys seen the interview with James Franco and Seth Rogen?
No.
Oh my gosh, it's hilarious. It was free on Netflix for a while.
All right.
You guys have to see that. Watched it again last night for the second time. Absolutely hilarious.
Okay.
But there's a just hilarious scene where Eminem is on there doing an interview. You have to see it. But anyway, it used to be free on Netflix. It was the one that got hacked. Remember about North Korea?
Right.
Oh, right.
They hacked it, so
Yeah.
they released it for free on Netflix. But
Yeah.
now you have to pay for it on iTunes.
Okay.
But anyway, they just throw out these crazy words, and everyone's like, "What?
What? What?
So, housing bubble?
Right. What are you talking about?
What are you talking about? Housing bubble? What housing bubble, Brian?
Yeah, well, 10 years ago when there was the housing bubble, it's very similar. The government wanted everyone to be a homeowner. They saw the benefits of home ownership, and so they allowed everyone to get a home by sort of a fogging the mirror test, and everyone could get a mortgage, even if they couldn't afford it. And so it came time for to pay the piper when demand went down, and then these companies, the mortgage companies, started going out of business, and then boom, the bubble collapsed, and we saw what that did to the economy. I don't know the true dollar amount of mortgages that went bad, but $1.4 trillion is a whole lot of money. And we were talking earlier about the fact that for the most part, you can't get rid of that debt in bankruptcy.
No, you can't.
So, it's like very small percentage of people can prove the right hardship or whatever. Yeah. And so if that's the case, then people are, saddled with it. And it's affected the housing market for sure. They said 35% of the decline in young American home ownership. This is an article I saw that the New York Fed did a study on. 35% in the decline of young American home ownership from 2007 to 15 is due to higher student loan debt loads. So it's affecting the housing market, which then bleeds into all the furniture they may buy, et cetera. So people are graduating, they're getting better education, but are they really getting ahead if they can't afford to be buying a home or doing other things?
Well, that's why you have to look at it as an investment. I mean, that's the key. If you're going to go to college, it has to be reviewed as an investment. You have to look at what kind of degree you're going to get, what the expected wage is, what your net is after taxes, because that's what you have to pay those student loans back with. I think it would be cool if they let you pay student loans back with your gross income. That would make some sense, but that's a whole nother. We'll get to solutions in a second. But you have to look at your net. So we say, oh, well, I make $60,000 a year, and I have, $120,000. It just takes 2 years. No. Mm-mm. $60,000 is your gross. Now let's talk about your net. Now let's talk about your living expenses. Yeah. Now let's see what's left. Because that's you're
in the negative already. Yeah,
it's a big deal. And I know a lot of people have 60, 80,000 who didn't even graduate because they were like, gosh, I don't even think I want to do this. What am I doing? I'm into it for 2 or 3 years. I've got all this debt. I don't like it. I don't want to get any more debt. I'm out. Now they're still bartending, which is the same thing they were doing in college, same thing they were doing before college. Nothing's changed except for they just,
They racked up a significant amount of debt.
And I have the worst case that I've ever seen, which I just came across recently, and this is extreme. But this person, which he will go nameless for now, but has $500,000 in student loan debt, graduated from law school, so graduated, has the degree, has the JD, has now failed the bar 3 times. $500,000.
Wow.
So if you think your student loan situation is bad, it could be worse. Like, that's as bad as I've ever seen. But again, that's a life sentence. What are you going to do?
Yeah.
And there's no, like I said, bankruptcy is not the option.
There's no escape.
You cannot get out of it.
No.
And I know that the government is looking at that as the alternative. And part of the problem is, how do you sell that? Because for the person that has $500,000 worth of debt, somebody has to pay it back. And either that person's going to pay it back, or we as taxpayers are going to have to pay it back. So that's where the conundrum is. And you can't be an elected representative that's going to go and say, okay, so what we want to do is we want to take the burden off the student loan, people that took out student loans, and we're going to take it away from them, and we're going to give it to everybody else.
Right.
You're not going to get elected on that principle.
Yeah, and I don't think you can have it be a tax-based situation. That's the trouble. I mean, thought was, so let's talk about solutions. I have ideas. I think the system itself is broken, but let's say we can't do anything about that. All we can do is deal with the debt. There's two ways to go about it. You could have some sort of tax advantage for the student loan payments. They could be, you could write them off, or you could pay them out of your gross, or there could be something there that you give that would be nice. It wouldn't make an enormous difference, but it would help. It would help ease the burden. And perhaps people who are living at home, they could take 100% of their income and pay towards their student debts, and they'd only have to do that for 2 or 3 years, and then they'd be free of it. Yeah. And free of mom and dad for finally. So it's like another 3 or 4 years added on to the 4 or 5 year cycle. So now everyone's like a doctor just to get your degree and get it paid for. But then doctors as well, same thing. But that's one option. The other option is to look at something with the law, like bankruptcy. Like, can you make it so that you could include these debts in bankruptcy? That's all you have to do is just say they can be included. Right now they're excluded. So student loan debts are excluded. You cannot put them in there, which doesn't make a lot of sense.
Right.
For the purpose of what bankruptcy is, for why it was created in the first place, why would you exclude this debt? Why is this debt excluded? Why is it excluded?
I don't know. It doesn't make
because
sense.
of a lobby, because the laws are written by people who are influenced by money. They were given lots of money to exclude this. That's what happened. Let's be honest with ourselves. So if we could just take that corruption out of the situation, then you would have student loans would be able to be included in bankruptcy, which means you'd have to qualify for bankruptcy. It means you'd have to be in a significant hardship situation, and you have to qualify through all the other means, the means test, etc., and you would be able to include those debts in. Now, if I am in a situation where I have a financial hardship and I have a bunch of student loans, I can discharge my credit cards, I can get rid of my car loans, my car leases, I can detach myself from my mortgage, all of those things, but I can't detach myself from the student loans. What the hell sense does that make?
Well, remember, a student loan is guaranteed by the U.S. government.
Yes.
So if it doesn't get paid by the person that is taking out the student loan, then it's going to have to be paid by the government, which again is us, is the taxpayers. So because you're guaranteeing these student loans, that's where you're going to start to run into the catch-22. If you stop guaranteeing, because if you said, okay, we can include them in bankruptcy, and if you include them in bankruptcy, that means all of a sudden everyone that's going to qualify for a student loan, that goes away. Because now all of a sudden the risk for those that are issuing the loans goes up significantly. So now it's like, okay, you're taking a risk on issuing a student loan. And think about
there should be a risk.
Right.
Well, it's a loan.
But you think about who is your typical student loan person? It's a kid that's just graduated from high school. They're just going to college. Do they have any idea what they're doing in credit?
Because the brain's not fully developed yet.
Yeah,
so let's get real about this.
Especially the males.
Yeah, right.
So does it make more sense to give them money or not?
Well, right.
Well, that was always the, when I can think back when I was in college, when the student loan checks were distributed, pizza parties were crazy. I mean, hey, I just got my check. Party at my house. Let's go. And you'll order Domino's until that check ran out. Well, of course, that check was supposed to be paid for tuition and stuff, and it's followed up by a phone call to the parents. Guess what? I spent it.
Right.
So that's who you're issuing with. So you've got to guarantee those, or else nobody would write a loan to an 18-year-old, a 19-year-old for that amount of money without the guarantee. So you take away, suddenly you add the risk of bankruptcy, which is a really that's going to happen. Definitely. Because all of a sudden the kids are like, oh, I spent all my money. I don't have it anymore. I can't pay this back.
Yeah.
So without that helpful U.S. guarantee, so they know they're going to get paid back, suddenly you're going to do it. And then you're going to run into the issue of Well, now there's no money to go to college. So that becomes, it's the other side of it. If you don't guarantee it, you're in trouble.
There are other compensating factors, though, within the loan business, right? So it's just like credit cards. Like those can be discharged. It doesn't mean that no one can get a credit card. It just means that the banks have to be a little bit smarter, a little bit more choosy about who they give them to, and they have to align the interests. They have to find someone who they think can pay them back.
Yeah, but
I think
what's the limit on a credit card versus a student loan?
Can I finish?
Please go right ahead.
Can I finish?
Please go right ahead.
So if it's the case that we have to be more careful about the students, like if we're saying that, well, no, they don't know enough, they're not smart enough to give a real loan. We have to give them money. Then there has to be either grants or something like that, because just what you're saying is like they're not worthy of a loan, but we're giving it to them anyway. So we're paying for that one way or the other. Either the kid is paying for that, or we're all paying for that together, but someone's paying for that, because if that kid has those student loans, now he can't buy a house, so Bryan can't make a commission, and someone else can't build the house and all that stuff. Right. So you pay for it one way or the other. But the point is that whenever you do that, things balance themselves out. So if you say, okay, well, we have to include it in bankruptcy, just like all the other loans that exist on the planet, or at least in this country, they're all includable in bankruptcy. It doesn't mean people can't get them. It just means it has to be done with a little bit more thoughtfulness. It has to be done with a little bit more awareness of who are we giving this loan to? And it aligns interests now. All of a sudden, the government and the bank who's issuing the loan, because the bank who's issuing the loan has to underwrite it and then sell it to the government, right? Right. So in them doing that, they have to look at it and go, you know what? Is this kid, does he have a good plan in place? Do we think that he'll be able to pay the money back? Does he have his head on straight? Does he know what he wants to do? And is what he wants to do, is that going to be able to get him in a position to pay us back? Or can mom and dad co-sign, which is what happens already a lot.
Right, well, yeah.
And in which case now you can't bankrupt the loan without them being included into it, or without deferring it to them. So the amount of loans that would be bankrupted, there would be some, there would definitely be some, but they would be small cases. My buddy, $500,000, he'd be one of them, for sure. Now that's someone who now has a life sentence as a result of his education. That's unfair. Now, that said, you could say, well, it's his fault. He didn't pass the bar, didn't study enough. He got himself in over his head. Why in the world do you have $500,000? It shouldn't take that much. But again, we're talking about a situation where you're giving money, an unlimited amount, without anyone oversighting it. It's just kind of like saying, well, we're giving loans to anyone and everyone, and we're giving them as much money as we want because it's backed by the government. There also needs to be some sort of line drawn there. It can't just be a free-for-all, where they're just giving money to whoever asks for it. I mean, that's crazy. So I think if you put some sort of consequence for the lending side of it too, which includes the government and the banks who are issuing the loans, then now you start to get everyone going, wait a minute, all right, what's going on here? What's going on? What are we doing? Who are we giving money to? Because right now it's just like, no, just give it to them. Just give it to them. Just give it to them. They'll have to pay us back. We're going to sell it to the government. That's wrong.
Well, you run into some statistics that Sallie Mae threw out there. And Sallie Mae is the biggest buyer of student loans out there. 90% of the families that have children assume their children are going to go to college. 90%. Okay.
In America?
In America. But less than 40% actually have a plan to pay for college. So
there's a big gap.
There's a monstrosity gap there. And that's the thing that it takes it that much further back, because it's an issue where if you're a parent, is it your obligation to save money so your kid can go to college? And that's debatable. You can take both sides of that argument.
Are you saying that your solution would be that there's some sort of mandatory savings, like taken out of your check, or something like that helps to go?
Well, if you make it mandatory, then of course there's the issue of, well, maybe my kids don't want to go to college. Maybe my kids, and who manages it? Does the government manage it? We've already seen what the government does to Social Security.
Right. Once you make something mandatory, then you have to
it becomes an issue. But these are just studies that were done, and so 90% of, and I did this. I have 2 kids, and when each kid was born, we started a college fund for them, and every month we put money into those accounts, and we did that throughout 18 years. Well, 18 years for my son. Almost 16 years for my daughter, so that they do have a college fund to go to college.
Steve, not everyone runs creditandcollectionnews.com, okay? So here's the thing, that's a great plan, but really what's the delta? What do we need to fix? Like if we say student loans can be included in bankruptcy, we only have to fix the ones that are lost in that. And let's say it's 10%. It'd be less. Probably 2 or 1%.
But how do you know?
Because just look at all of the debt that's out there and how many people file bankruptcy on that debt. It's a very small amount of it. Now, percentage-wise, as far as like debt holders. Now, percentage of amounts, I'm not sure, but it's a small percentage. So, but that percentage, whatever it is, let's even call it 5%, which is way too much. But let's say it's 5%. That 5% is what we have. That's the delta. That's what we have to cover. It's all we need to pay for is insurance for that. We just have to get insurance against all of the potential bankruptcies and we have to get that covered through an insurance company. So we just have to pay that premium. You can pay that premium in a lot of different ways. You can pay that premium through, adding it to the paycheck taxes. You could pay it through a number of things. But that's really all that needs to be paid for in order to say, you know what, let's let some people out of jail. Because we're putting people in prison with student loans, and we're putting kids in prison with student loans. And it's a life sentence.
And, so as we've been talking for the last, 10 or 15 minutes about this, obviously from my background being in real estate, it's going through my head that what we're talking about is FHA, loans, VA loans. The government's already doing this. They're putting a backstop in, FHA premiums for the government guaranteeing mortgages. We're talking about the same thing, guaranteeing student loans.
Insurance.
It's the exact same thing. Qualifying for the student loan is like your credit score in a mortgage. So it's very, very similar. But how much do we want our government to have our hands in? Who's going to insure? The insurance is going to be a private insurance? Is it government insurance? So
you could just, if you're talking about like FHA, VA, you could just handle it right there on the spot. Essentially, you get your $30,000 student loan, and it becomes $30,300 because you have to pay a 1% premium.
Who's the insurance company?
It would be self-insured. If you do it just like FHA and VA, it would be insured through them. It would go into their insurance fund, and that would cover, the bankrupt items. And if they needed to increase it, if that fund got low, then they would increase it from 1% to 1.5%. You see it happen with FHA,
right?
Where like it was 0.75 for a long. It was 0.5, and then 0.75, right. And then 1.5, and
right.
1.75, and then now it's back to like 1.25. So it fluctuates based on how that fund is doing, and that covers the losses from what essentially are their claims,
right?
Because they figure they can get 80% of the property value. Now the difference is
collateral.
You don't have any collateral with the student loan.
Right. Nope. So it's a credit card. It's a big credit card.
It's a big credit card. So you're not going to be able to have that 80% cushion expectation with the student loan debt. So your insurance cost on the federal student loans would probably be more like 5%. So if you're getting a $30,000 loan, you might have to pay $600 premium or something like that. So instead of getting $30,000, it's $30,600.
Right.
That's not an enormous difference, really, for the individual. If that were to accumulate to the point where it could cover the losses and we could make student loans bankruptable, which people are like, yeah, you should pay your debts back. I get it. Yeah, you should. But sometimes you can't. And the whole point of the bankruptcy law is to make it so that there's no debtor's prisons. Well, people are walking around in prison. Like, you could go and you could try to move away. And in fact, my buddy, the $500,000, we tried to figure out how. Like, how could you get away from this? Is there any way? Could you go to China? Could you go to the UK? Could you move to the Bahamas and just get away from this? There's no way. There's no way out.
Well, that's you kind of hit on something right there. Make a way out. So do you work for the government? So a certain percentage of your debt is going that. If you took out all these loans to become a doctor, and then you have a need for a doctor in Alaska or Hawaii or someplace where they're lacking in number of medical practitioners, that's an advantage. Now, you brought up your friend, the lawyer. That goes back to when you said, well, you have your degree in psychology or you have your degree in, you get a law degree and you want to be a lawyer. Okay, well, how do you know that this person is not going to pass the bar?
You don't.
And you don't. So you're taking a risk upon that. And you're looking at it and you're saying, okay, well, this guy wants to be a lawyer. So who's the person that's going to tell that person, you're obviously not going to be a lawyer?
Who's the person that allowed it to get to $500,000? That's the problem. See, so when you talk about responsible lending, which there's rules and regulations and there's all kinds of things out there for just about every type of loan that exists to help protect against predatory lending, except student loans, the most predatory lending in existence.
Well, exactly.
Dramatically more predatory than credit cards, payday loans, and all that. Dramatically more predatory.
And huge, I mean, bigger dollar amounts. We're talking huge dollar amounts.
Big dollar.
Well,
this
is
let it get to 500K. I mean,
well,
that's who's responsible.
it's actually it's very easy to get to that, to get to those numbers. And I put together some what's it cost to attend a university.
Oh, good. I was going to bring this up earlier.
You know, so you kind of look at some of the costs, and I'll take some of the local universities to start with. San Diego State, where I went, and now my son goes, the cost to attend, averaged in the year, is $23,714.
They told me this when I was at Claremont last time. There was someone who was going to SDSU, and I said, "Have you guys checked to see how much it costs?" And they told me $24,000, and I about dropped dead.
Yeah, $24,000.
That is crazy.
$24,000. Now, it's how much?
$100,000.
How much of that? $7,000 of it is in tuition. So the other parts of it are housing, food, books, and you know, when I went to school, books were more expensive than tuition.
They were very expensive.
Books are still very expensive. And
the whole ebook thing hasn't caught on yet.
You know what? And well, that actually has, and they've countered it already, because they came up with ways that you have to buy a new book with a code so you can turn in your homework online. They're keeping it artificially high.
The authors have to keep the royalties.
Yeah, you know, it's a whole different story.
A new scam has been born.
Yes.
Amongst the biggest scam in existence.
Right. I mean, they came out with ways to, like, ebooks to take it away, and they came up with a way to counter that. So that's you know, like I said, we could talk for hours upon that. But just looking at some of the numbers, San Diego State is a little under $24,000. Cal State San Marcos is a little over $22,000 a year. UCLA is just a hair under $30,000 a year. So
that's where my daughter wants to go.
And good luck with that, because that's UCLA is one of the hardest schools to get into in the country.
Really?
It's very difficult.
For someone, especially for someone who lives in California.
Again, another conversation. We could probably go on for hours about trying to get into different schools. San Diego State had 86,000 applicants.
86,000.
86,000, and less than 8,000 got in.
That's remarkable. Daniel, we see your comment, by the way. If you have comments, go ahead and make them. We will get to comments shortly. I see what you're saying there, and I will address that.
But if you start to look at the numbers, and
that's why the tuition's going up, though.
That's why tuition, I mean, but there's so much money out there to be had through student loans, so it causes an artificial inflation at the colleges, so they can keep increasing these tuitions. But that's what it costs. And what they found, they did studies, and they found at San Diego State, for example, they have what's known as the Sophomore Success Program. Keep the kid on campus for 2 years instead of 1 year requiring them to stay on. The graduation rate goes up significantly, over 15% higher when you do that. So they did the studies and they found that. So again, you're keeping your kid on campus, you're paying for on-campus housing, and that just keeps your costs going up. So the kid does, you know, so how do you counter all these costs? Do you go out of state? No.
Yeah, even more money.
For Arizona, the cost to attend for a California kid, the average cost is a little over $47,000 for the University of Arizona.
$200,000 for 4 years, if it takes you 4 years.
Right. If you say, well, okay, that's Arizona, but you know, I want my kid's smart. I want my kid to go to Harvard. Okay, a little over $64,000.
I see USD is on there.
USD is on here, and USD, the cost to go there is $60,000 a year. It's a private school. So
That's
whether
just
you live
remarkable.
in-house or out, I mean in-state or out-of-state, it's $60,000. Now, USD does offer a lot of aid to help their students. The average aid USD is $21,000. So that brings that $60,000 down to $40,000. That's still $40,000 a year.
That's a lot.
Yes,
And 4 years, $40,000. That's $160,000 for an undergrad degree.
Yeah, and that has to come from somewhere. at some
It
point.
certainly does, and that's where the largest holder of student debts in the country, the fastest growing one of all people that hold student loans, the fastest growing is the senior citizen group.
Really? Co-signing?
Yeah, because you're not seeing 85-year-olds, wheeling down the campus. Oh yeah, go State. No, that's not. It's actually families are being burdened by this. So kids are going to their grandparents, not their parents, because their parents are now paying for everything else going on.
Parents are like, I paid for 18 years of you.
Get out, right? Get out.
Right. So they're going senior citizens. I'm not quite there at that age yet, but senior citizens are now the fastest growing holders of student debt.
Incredible.
And those are the ones with no income, no employment income if they've already retired.
Right.
So their debt's going up while
their debt is going up, and they always say when you get to retirement, the idea is to have no debt, and you can live off Social Security. Either your place is paid for, or you have enough income to cover your rent for your. But now you're suddenly throwing student loan debt on the senior citizen group. That's where you say, what's going to happen to the bubble? That's what's going to burst the bubble. When the housing market got so expensive, and you could rely on 2 incomes, but you couldn't pull that third income from somewhere. You couldn't make your kids go to work to pay that third income to afford the house.
Yeah, right. Where'd you go?
So this is what this student loan crisis is causing. Is now kids are saying, well, I need the student loans and I need somebody to co-sign, and I can't let my parents do it because my parents are now paying for everything else and they can't afford more debt. So they're going to the grandparents.
Great birth control today. So just financial birth control.
Yeah.
Teach your kids a sport and get them very good at it, because that's your best shot.
Golf is actually for if you have a daughter.
And then the number one.
Emphasize to her, now I don't know if it's still true, but it used to be true, that 50% of women's golf scholarships went unused.
Really?
Yeah. So pick that one up.
Okay.
You said you have a daughter. Yeah.
Solutions. I like it.
This volleyball too.
She's a volleyball player.
And it just depends.
Yeah.
Remember, this is where Title IX came in.
Yes.
To help, because of all the male scholarships, for female scholarships to be equal at a university. That's where they had to start adding those.
Well, let's start talking solutions. I want to get to Daniel McKee's comment here. He says, encourage parents to save money, to save more by making 529 plan contributions tax deductible. You start to get into the financial planning element. I think Steve talked about what his strategy was. My strategy with Maya has been since the day she was born, every month $300 a month into a UTMA. You do that, you just buy the market. I buy the IVV, which tracks the S&P, very low cost, 0.07% cost, virtually no cost. Trade through Fidelity, no cost to buy, so no trading costs, no commissions.
Yep.
And over the course of 18 years, that will accumulate you a nice chunk. It'll be 6 figures, for sure. So that's a great start. Not enough if she wants to go to UCLA, right? There's more there that needs to be, unless she gets a scholarship or something like that.
Well,
so saving is definitely a good idea. And I think when you're talking about, if they're going to pass something that's tax-oriented, I highly doubt that it'll be in the 529 realm, because that's already seen as a tax advantage area.
Yes.
So I really don't think that is what it's going to be. But there are other things, and I want to talk solutions at this point, is, to go to a community college for a couple of years, or a junior college.
We were talking about that.
This is something that a lot of people, even when I was talking to the seniors in Claremont, they were saying, I'm going to go to community college for a couple of years to save money. Because these universities are the ones who have the big price tags. There's still, more affordable education options out there.
And you can even go to Palomar College, which is in San Marcos, for free. If you live in the San Marcos School District and your child goes to the San Marcos School District, you can go to Palomar College for free.
Seriously?
Yes.
Seriously. No tuition at all. And for 2 years, and then you can go to any in-state university and graduate from there. It doesn't matter where you start;
Right.
it just matters where you finish.
Where you graduate.
Right.
That's amazing. Free college.
Well, that's what.
That should have been our headline.
The goal of this PACE promise at San Marcos, where my kids went and Brian's kids go, the idea is they want any kid that wants to go to college has the ability to go to college. And that was the idea behind this.
I don't think it's just about going to college, though. It's about making it a successful thing. Because everyone can go to college right now. Like if you get in academically, like you said, you can get the loans, you can go. They'll welcome you in there with open arms. But is it a successful endeavor. Is it a smart thing to do? Does it work out for you? Because people get all excited about going to college, they get all excited about graduating, and then reality hits.
Well, and that's a lot of. I also teach classes on this, and you try to look at, and if you go to a lot of, my son took this class at San Marcos High School, and it was through Palomar, and they pushed the concept of understanding what a career pays, so that they understand what they can make for a living, and then you start to sit back and say, well, I want to be a rock star, and you say, okay, you want to be a rock star, okay, and I'm going to go to college, I'm going to learn all about music, and I'm going to be a music major, and I want to be a rock star, and all that, and then you start to look at, well, what are the chances of you actually making a living doing that?
And just keep playing your guitar. Don't go to college.
The percentages are so low that the multimillionaires, the ones that make a living off of doing this, are less than 1%.
Right. It's like what are the industries that are hiring? What are the growing industries? What's the need?
That can change in 4 to 5 years, though.
It can, but you start to look at what's real and what's not real.
Yeah, rock stars, that's not going to change, I think, in 4 or 5 years.
I want to be a professional athlete, and do that. And you understand that, from going from playing high school sports to playing professional sports, and making a living out of it, it's less than 1%.
Yeah.
Way less.
So that's concept versus reality.
Yeah,
and as a parent, you need to guide your child to something that's.
Who are you to rain on your child's parade? If he says,
I want to be the one who's paying for it.
It's their dream. What if they do make it? Or what if they hold it? What if they hold it against you for the rest of your life? You told me not to follow my dream, and I've been suffering ever since, and that's why I go to the bottle every day.
As our parents used to say, at the 4 year mark, we talked about this, where our parents said, "Oh, we'll pay for college for 4 years." At 4 years plus 1 day, it's cut off.
Yeah.
You better have graduated so you can have a job to pay for yourself.
Oh, I have the same setup. I told my daughter, I have a fund for you. That's yours. That's it. The rest is on you. Yeah. So get a scholarship, do whatever, but I did my part. Let's get to one more comment here from Dion. It says, my friend just signed up with blah, blah, blah. We don't like that company on the show. Reduce the monthly payment. More importantly, more of the funds are going towards the principal. We like Loan Libre on this show. But my mom's commenting. Look out! Look out!
7 years of college.
She's down to wind it up here. So yeah, no question, Dion, that there are other options out there now for people as far as recalculating, recalibrating. They've come up. There's several student loan services. We have the one that we like listed on smartersandiego.com website. We know those people here. They're in San Diego. I know the people who own the company. I trust them 100%. They do a great job. It's a very inexpensive way to go about getting your student loans consolidated, reorganized. There are income-based repayment programs, et cetera, that you can sign up for there, and they help you out with all that stuff. Loan Libre, you do it through there, and you can basically do it on your own. Super inexpensive. Let's see. What did my mom say before I read it out loud? Kids should buy life insurance on their parents.
What is that? What exactly is she saying?
No, because if you're worth more dead than you are alive, that is not a good thing.
No, I mean, she's right. I mean, it does make sense. Like, your parents shouldn't have to pay for their own life insurance. You're the ones who are benefiting. You should pay for it. Like, I should
when they bring you bubbling brew that looks a little smoky, that is not a good thing.
So let's repeat the free college thing. So because we have to wrap up, but I mean, this has been a great conversation, and there's several takeaways here. That is enormous, though, for the people who live in the San Marcos area.
Absolutely. So if you live in San Marcos, they have the PACE promise. You can you go to Palomar College, which is the local community college. You go for free, no tuition for 2 years, and then you go transfer to a college in California, graduate from there. So you just now saved 2 years of tuition.
Absolutely.
It's so much more affordable. I have no problem talking to my kids about that and saying, hey, you know what? Because they're 18 years old. Do they really know what they want to do when they grow up? Let's give them the extra 2 years to figure it out while still getting an education, and then they can go on to a 4-year university, which is now only 2 years, and they're more likely to have a better decision, I think, as far as what they want to do.
Exactly, and that's something that Palomar. When I was saying what's the cost to attend, Palomar is about $15,000 overall, but that includes almost $13,000 of it is housing. So
my kids won't need the housing.
If you're looking at kids that are living at home, now you're looking at $2,000. And if you live in the San Marcos School District, you're looking at free. Of course,
incredible.
that means also that your kids are living at home for the next extra 2 more
There's a
years.
mixed bag to that.
So they can still move out and live in there.
The advantage and disadvantage of doing this. But those are things to look at. Scholarships are, and there are lots of scholarships out there. My son got some scholarships. He got, and there were some easy ones. One of them is CSF, which is just something they apply for if they have good grades every semester in high school. They get a $250 scholarship at the end of their 4 years, which helps pay for their books for one semester. Again, it's $250. He also applied to some other for scholarships in my industry that I work in. There are lots of research things you can look at. There's thousands of scholarships out there. A lot of them go unused that your kid can qualify for that can help you out. So there are other ways to bring money in to help pay for college. There's grants, but you have to work for them.
Yeah.
And you have to research them. And you have to go through the process. But if your kid is going to go to college, that's part of your responsibility as a parent to look into, to help your kid and to help reduce down that burden on the back end. So you help pay for it in the front end.
I think we've made all the parents with 3 and 4 kids very, very nervous today. Well, thank you guys so much for coming in. It's been an awesome segment. Really, really appreciate your time, Steve. Nice to meet you in person.
Absolutely.
Your website has been an amazing resource for me for years, creditandcollectionnews.com. And we got more coming up here on Smarter San Diego, Facebook Live, where we guarantee to make you smarter than everyone else.